Listen carefully, because the silver market is sending a message most investors still refuse to hear. They are watching the price, counting daily gains, studying short-term charts, and waiting for another familiar pullback. But I am not talking about a routine move. I am not talking about a temporary burst created by headlines or nervous traders. I'm talking about a change in how silver itself is being valued. A new pricing regime is taking hold, and by the time the majority accepts it, the most important stage may already be behind us. You need to understand what is happening beneath the surface. Markets do not change because people suddenly agree that conditions are different. They change because the old structure can no longer carry the pressure placed upon it. For years, silver was priced inside a world built on confidence in central banks, debt expansion, stable currencies, and the belief that industrial supply could always respond when demand increased. That world is weakening. The assumptions holding the old price range together are being challenged one by one. This is not speculation. Look at the larger system. Governments across the developed world are carrying debt burdens that cannot be managed indefinitely under genuinely restrictive conditions. Higher rates raise refinancing costs, weaken budgets, pressure banks, slow credit creation, and expose fragile borrowers. Yet lowering rates too quickly risks reviving inflation, weakening currencies, and damaging confidence in monetary discipline. Policymakers are trapped between financial instability and purchasing power erosion. There is no painless exit. History has proven this again and again. Long-term debt cycles do not end with a polite adjustment and a return to normal. They end when authorities must choose which form of loss the system can tolerate. They can allow defaults, contraction, unemployment, and political unrest, or they can create liquidity, suppress real rates, and transfer the cost through currency debasement. Governments usually choose the path that delays visible pain, even when it creates deeper monetary consequences later. That decision changes how capital behaves. At first, almost nobody notices. Cash still appears safe. Bonds still appear orderly. Equity markets may remain elevated. Commentators continue debating monthly data as though the system is moving through another normal cycle. But underneath that appearance, investors begin making quiet adjustments. They shorten duration, seek scarce assets, reduce exposure to promises dependent on policy credibility, and ask whether nominal returns are actually protecting real wealth. This is where silver becomes more important than most people realize. Silver is not simply a smaller version of gold. It occupies two worlds at once. It is a monetary metal with centuries of history, but also a strategic industrial input required by the modern economy. That combination becomes powerful when monetary stress and physical demand rise together. Gold usually receives attention first when confidence in currencies weakens. Silver often follows later, but when it moves, it can move with greater intensity because the market is smaller and more sensitive to incremental capital. The market does not need everyone to participate. It only needs enough serious capital to recognize the imbalance before the crowd does. Industrial demand is also becoming structural. Solar systems, electric vehicles, semiconductors, data centers, advanced electronics, medical equipment, defense technology, and energy infrastructure all depend on silver because of its conductivity and reliability. It is not optional. Manufacturers cannot simply remove silver from critical systems because the price becomes inconvenient. They may reduce usage or redesign components, but the underlying requirement remains. Now examine supply. Most silver is produced as a byproduct of mining for copper, zinc, and lead. Silver production cannot expand rapidly just because its price rises. New mines require years of exploration, permitting, financing, construction, and development. Supply responds slowly while demand can accelerate quickly. That is the combination that creates repricing pressure. Most people remain psychologically anchored to the old market. They remember failed breakouts, long consolidations, and years of disappointment. They assume every rise will collapse because that is what happened before, but the past only remains useful while the forces behind it remain intact. When debt conditions change, monetary credibility weakens, industrial consumption expands, and supply remains rigid, the old ceiling stops being a law. I want you to recognize the difference between a speculative rally and a structural transition. Speculative rallies depend on excitement. Structural transitions depend on necessity. Excitement can disappear overnight. Necessity continues building through corrections, doubt, and silence. That is why shallow pullbacks, persistent buying, and stronger support matter. They reveal that capital is no longer treating weakness as a reason to leave. It is treating weakness as an opportunity to accumulate. The real question is not whether silver can rise another 10 or 20%. The real question is whether the previous pricing framework can survive the monetary and industrial pressures now forming against it. I believe that framework is already beginning to fail. Once a pricing framework begins failing, the transition rarely looks clean. You will see sharp advances followed by sudden reversals. You will hear confident declarations that the move has ended. Analysts who ignored the early signals will point to every correction as proof that nothing fundamental has changed. This is how markets protect opportunity from people who require certainty before acting. They create enough volatility to force weak conviction out before the larger trend becomes obvious. You must not confuse volatility with invalidation. Silver has always been volatile because it is a relatively small market influenced by monetary flows, industrial demand, futures positioning, and physical availability at the same time. That volatility can become even more extreme during a regime shift. If buyers repeatedly appear at higher levels, the structure is telling you that the balance of power is changing. Look beyond the daily chart. Physical deficits cannot be solved by sentiment. Inventories can absorb shortages for a while, but stored metal is finite. When annual consumption continues exceeding newly available supply, the market begins drawing down the buffer that once concealed the imbalance. At first, this process seems harmless because delivery continues and industrial users receive what they need. But as accessible inventories decline, competition for reliable supply becomes more serious. Manufacturers do not wait for empty warehouses before responding. They extend contracts, secure future deliveries, diversify suppliers, and carry more inventory. Each defensive decision removes additional metal from the freely traded market. What looks like ordinary procurement can become a quiet contest for availability. The public may see a stable quoted price while commercial buyers are already behaving as though future supply carries greater risk. That is how structural tightness develops. It does not require every buyer to panic. It requires enough essential users to become less willing to depend on immediate availability. Once that behavior spreads, the marginal ounce becomes more valuable. Markets are priced at the margin, and in a constrained market, small changes in demand can produce disproportionate changes in price. Now add investment capital. Silver remains tiny compared with global bond equity and currency markets. A modest reallocation from conventional assets can therefore create an impact far larger than most people expect. When portfolio managers decide that monetary risk is no longer temporary, they do not need to abandon the financial system entirely. They may shift only a small percentage toward hard assets. But when trillions of dollars are involved, a small percentage is not small to silver. This is why I keep telling you that the new regime will not be driven by one group. Industrial users, individual investors, institutions, funds, and strategic buyers can all enter for different reasons. One seeks conductivity, another seeks purchasing power protection, another follows momentum, another wants diversification away from currency risk. Together, demand converges. That convergence is what turns accumulated pressure into repricing. A single narrative can fade. Several independent forces reinforcing one another are harder to reverse. Debt expansion supports the monetary case. Electrification supports the industrial case. Restricted mine supply supports the scarcity case. Declining confidence supports the investment case. Improving price behavior supports the momentum case. When these forces align, the old valuation range becomes increasingly unstable. Most investors will still wait for a dramatic announcement. They expect a central bank to admit that policy has failed, a government to acknowledge that debt is unsustainable, or a major institution to declare silver strategically mispriced. That announcement may never come. Institutions rarely confess structural weakness before markets have already adjusted. The evidence appears first in behavior: firmer floors, stronger recoveries, persistent physical demand, and increasing competition for supply. Ray Dalio's debt cycle framework matters because it explains why this pressure is not isolated. Excessive debt changes political incentives. Leaders cannot easily choose austerity when households, businesses, banks, and governments all depend on affordable credit. The system gradually becomes biased toward intervention. Every crisis invites another facility, guaranteed liquidity program, or accounting adjustment. Each measure may calm the immediate problem, but it also reinforces the expectation that monetary support will return whenever instability becomes unacceptable. That expectation weakens discipline. Investors begin understanding that currency units can be created far more easily than scarce resources. They stop asking only how many dollars an asset may gain and start asking what those dollars will purchase later. This is the psychological turning point. When preservation becomes more important than nominal yield, hard assets receive a different kind of demand. You need to think about your own positioning before that shift becomes consensus. I am not telling you to chase every price increase or ignore risk. I am telling you that relying entirely on assumptions from the previous regime may be the greater risk. Wealth protection begins by recognizing when the environment governing assets has changed. Silver is now giving that warning, and the warning is becoming harder to dismiss. The next stage of this transition will be shaped by something even more powerful than scarcity alone, the loss of confidence in policy control. Most people still believe central banks can fine-tune inflation, growth, employment, and financial stability without creating serious trade-offs. They assume every problem can be managed with a rate adjustment, a liquidity facility, or a carefully worded announcement. But the deeper the debt burden becomes, the less freedom policymakers actually possess. You need to understand the trap. If inflation remains persistent, authorities are expected to keep monetary conditions tight. Yet tight conditions increase the cost of servicing accumulated debt. Governments must refinance enormous obligations at higher rates. Corporations face heavier interest expenses. Households struggle with credit. Banks hold assets whose values become vulnerable when yields rise. The longer restrictive policy remains in place, the more pressure moves through the system, then something weakens. It may begin in commercial real estate, government funding markets, regional banks, consumer credit, or heavily leveraged companies. The precise location is less important than the pattern. Once instability threatens the broader structure, officials are pushed toward intervention. They may call it temporary support, emergency liquidity, market stabilization, or technical balance sheet management. The name changes. The monetary consequence does not liquidity returns because the alternative becomes politically and financially unacceptable. This is how a system gradually sacrifices purchasing power to preserve nominal stability. It does not happen through one dramatic declaration. It happens through repeated decisions that appear reasonable in isolation. Each intervention buys time. Each delay adds debt. Each new layer of debt makes the next intervention more necessary. Ray Dalio's framework is valuable because it forces you to examine incentives rather than promises. Policymakers may sincerely want stable money, controlled inflation, sustainable growth, and orderly markets. But when those goals conflict, they must choose priorities. In highly indebted systems, preventing collapse usually becomes more urgent than defending currency value. That does not mean currencies disappear tomorrow. It means the long-term bias moves toward financial repression, negative real returns, and gradual debasement. Silver responds to that environment because it cannot be created through policy. It must be discovered, financed, mined, refined, transported, and delivered. Every ounce represents real energy, labor, capital, and time. When monetary units expand faster than scarce productive resources, the nominal price of those resources eventually adjusts. The timing is uncertain, but the pressure is not imaginary. Geopolitical fragmentation adds another dimension. The global system is becoming less cooperative and more strategic. Governments are reconsidering where essential materials come from, who controls processing capacity, and whether supply chains can survive political conflict. Industries that once optimized entirely for cost now being forced to consider security, redundancy, and domestic access. That change raises the value of reliable inventories. Silver sits inside many technologies nations consider essential. Power grids, communications equipment, advanced weapons systems, satellites, medical devices, computing infrastructure, and renewable energy all require dependable electrical performance. When governments begin treating materials as strategic rather than ordinary commodities, procurement behavior changes. Buyers become less sensitive to minor price increases and more sensitive to availability. This matters because silver's market is not deep enough to absorb unlimited strategic buying without adjustment. A large sovereign fund, industrial consortium, or institutional allocation can represent a small decision in the context of global capital, yet a major force inside silver. That imbalance between the size of potential demand and the size of the available market is one reason repricing can accelerate faster than conventional models expect. Accessibility makes the process more explosive. Investors can now gain exposure through physical products, exchange-traded vehicles, digital platforms, retirement accounts, and global brokerage systems. Capital no longer requires months to discover a theme and build access. Once conviction spreads, money can move almost immediately. In a large market, that speed may be absorbed. In silver, it can alter the structure itself. Then momentum begins attracting participants who were never interested in the original macro thesis. Trend systems detect relative strength. Funds increase allocations. Media coverage expands. Retail interest returns. Products holding physical metal must secure additional inventory. Rising demand tightens availability, and tighter availability strengthens the narrative that attracted demand in the first place. The feedback loop becomes self-reinforcing, but do not mistake that future phase for the present one. We are not yet at universal enthusiasm. Skepticism remains strong, positioning remains limited, and many investors still view silver through the disappointments of the past. That is precisely why the opportunity remains misunderstood. Major regime changes begin when evidence improves before belief does. You are watching that gap now. The structure is strengthening, the monetary backdrop is deteriorating, industrial necessity is expanding, and supply cannot respond quickly. Most people are waiting for certainty. Markets will not give it to them cheaply. By the time consensus arrives, the price required to attract sufficient supply may be materially higher than today. Now, I want you to consider the mistake that destroys investors during a regime change. They recognize the argument, agree with the evidence, and still remain unprepared because they expect the market to offer one final perfect entry. They wait for a clear signal without volatility, a pullback without uncertainty, or confirmation without a higher price. That moment rarely arrives. Structural transitions force you to choose between acting with incomplete certainty and reacting after the new reality becomes obvious. This does not mean abandoning discipline. It means replacing passive hope with a deliberate strategy. You need to decide what role silver serves inside your broader protection plan. Is it insurance against monetary erosion? Is it exposure to industrial scarcity? Is it diversification away from financial assets whose value depends on stable policy? Your answer determines how you should think about allocation, time horizon, and volatility. The greatest danger is treating silver like a lottery ticket. That mindset produces emotional decisions, excessive concentration, and panic during corrections. A serious investor does the opposite. He studies the structural thesis, respects risk, builds exposure according to his capacity, and accepts that even a powerful long-term move will contain violent setbacks. Conviction without risk control becomes recklessness. Risk control without conviction becomes paralysis. You need both. Remember what drives the argument. Global debt continues growing faster than the political willingness to impose lasting discipline. Governments remain dependent on refinancing. Central banks remain responsible for protecting a system that cannot tolerate prolonged stress. Industrial demand continues expanding through electrification, computing, defense, and energy infrastructure. Mine supply remains slow and largely tied to the economics of other metals. Available inventories cannot cover persistent imbalances forever. None of those forces requires an immediate crisis to matter. That is the point most people miss. Silver can enter a new pricing regime through gradual accumulation, tightening supply, changing institutional models, and persistent currency erosion. The process may appear calm until several pressures meet at once. Then the adjustment can accelerate with a speed that makes earlier hesitation extremely expensive. This never ends quietly because monetary systems do not surrender purchasing power without changing behavior across every major asset class. When real returns remain inadequate, savers search for alternatives. When bond markets become less reliable, institutions widen their definition of protection. When strategic materials become harder to secure, industrial users compete more aggressively. When price confirms the shortage, momentum capital arrives. Each stage invites the next. Most people will respond late because they are trained to extrapolate stability. They assume tomorrow will resemble yesterday. They trust familiar ranges because those ranges survived previous disruptions. But a range is not permanent simply because it lasted for years. It is only the visible expression of conditions that may already be disappearing. Ray Dalio's central lesson is not that anyone can predict the exact day a cycle turns. It is that you can identify the pressures, incentives, and imbalances that make the old order increasingly unsustainable. You can see when debt service is becoming restrictive, when policymakers are losing flexibility, when currency credibility is weakening, and when capital is beginning to prefer scarcity over promises. Those signals do not provide certainty. They provide preparation. And preparation is the dividing line between those who preserve optionality and those who are forced to react. When markets move slowly, everyone believes there will be endless time. When the move accelerates, liquidity, premiums, and psychology can change together. The asset that once seemed boring becomes difficult to buy without emotional pressure. The allocation that once appeared unnecessary suddenly feels urgent. Watch the market's behavior instead of demanding a headline. Watch whether buyers defend higher levels, whether physical premiums remain firm, whether industrial procurement becomes more aggressive, and whether monetary authorities retreat whenever financial stress rises. These developments may unfold at different speeds, but together they reveal whether the repricing thesis is strengthening. Evidence arrives through accumulation before it arrives through consensus. Do not wait for fear to make your decision. Fear produces poor sizing, poor timing, and weak conviction. Make the decision while you can still think clearly. Examine your exposure. Examine your dependence on currency stability. Examine whether your portfolio is built for the world that existed or the world now forming. I am not promising a straight line, and I am not telling you that every rise will continue. I am telling you that the foundations beneath silver are changing in ways the old pricing regime was never designed to absorb. Debt, policy constraints, strategic demand, and rigid supply are converging. The market is beginning to recognize it. The real question is no longer whether silver deserves attention. The real question is whether you will understand the transition before the crowd forces you to understand it at a much higher price.